All right. So let's kind of go through, high level, right? Financial statements again. I already went through them, but I'm happy to quickly just revisit them. I'm sure it's, different perspective. I understand you all are really trying to understand, you know, just where we're at in terms of this, and, and building these high level analytical models. It's really going to help you over and over again. So, again, right, these cells are green. I'm using, the Macabacus Control A to color it, right? So look, if I do this, look, I'm gonna say 22,000 here, right? I'm just gonna give you an example because it's already colored. So equals this, okay? That's a hard coded number. Remember, I hard coded that for the case. Control Alt A, boom, green, okay? And it does that for everything. You can do Control A, right? Control A will select everything. Control A select everything, right? So do Control A again, and then Control Alt A to color everything, you know, in the spreadsheet, which I've already done. That's what the beauty of Macabacus, and this helps you just understand where things are coming from, right? Because if this was all black, you all might think, okay, he's doing this on the sheet, but no, it's actually pulling from a different tab in the model, which means this is where the assumptions are coming from, right? Because this is a cleaner format, effectively. But it's important to look at all this. It's important to have in an LBO. It's important to have everything on one tab, right? Really have it flow through. I mean, you want to be able to audit everything in a clean way. So I would always recommend, build a model like this. But you can have other tabs where you've got the data. And actually, in the industry, that's how it typically always works. Is they've got the client data that comes in on these tabs. It's actually typically a lot more complicated than this, and then you're kind of rolling. So remember too, I discussed about the sum ifs, right? But this is pulling sum ifs here. Okay, I'm not just saying equal it because it helps me. Then I can just run these formulas through rather than having to set it up for every single one, um, and manually manipulate it. So doing F to F, right? I'm keeping this not static, right? So there's no dollar signs on this, but there are dollar signs here on the A to A in the mapping key column, right? And you can hide that column a lot of times too. By the way, you can group it. I'll show you guys real quick. Yeah, I already did it. So what you do is you click data, click outline, you click group, right? I'm going to ungroup it real quick. Okay. So a lot of folks will actually hide these tabs. I disagree with that a lot. Okay. Because you can come in here and you can think, okay, this is it. But there is actually column A hiding there. So you don't really know what's going on. You can miss it if you're not too detail oriented. So if you click group and now you get rid of it, well, look, now it looks good when I open the model. But if I want to open it, I see there's a mapping key. So a lot of people, that's the industry best practice to do for that. So let's talk more about this sum ifs again, right? Which again, I already talked about it, but why not discuss a little bit more? So we're going to keep this stat. We're going to keep this moving. Again, this was a nuanced situation where you've got this annualized 4-month delta. Typically, you don't have this. So a lot of times the financials are moving one to one, and it can move, um, freely, and everything's going to map in. This is an area where that didn't necessarily happen. And at some point, I might even build like a financial model based on some kind of, just maybe dummy data to show you all how to build like a monthly forecast and, how to manipulate financials. But at this point, I think I'm explaining it well enough. You've got, you know, keep the mapping key dollared, right? Because no matter what, if I move from 2025 to 2024 or 2025 to 2026, the sum can move. The sum range can move, right? We want the numbers to move, so I'm not making all these formulaic situations. What we don't want to move is the mapping key because that's going to be static, right? Because that's if you go back here, that's what's going to change. As we move down here, we want like revenue to pull and then gross profit to pull and adjusted EBITDA to pull. But we don't want, it to start pulling in this column to this, right? It's like it's got to match revenue to revenue, gross profit to gross profit. So that's why you got to keep that column for the mapping key mapped. Okay. That's what you call your criteria range. And then your criteria is just right here. And again, you want the row to not move, but you want the column to be static because you do actually still want it to move. Okay. When you're doing things like date, you can a lot of times put date functions. That's when you'd want the dollar on the row, but not necessarily the column, because you might want it to go across certain months, time periods, but you want it to stay on this one date time frame. So, anyways, you guys will learn that when you get an IB. I don't believe you're going to have to do that for your interviews, but you know that's um, when I was going through Wall Street prep and other preps, I did not have to do that in depth. Right now, you just need to understand the basics, right? You need to understand how do you build a three-statement model? How do you build DCF? How do you even build an LBO? I mean, I had to build an LBO when I tried to lateral for a big bank in Chicago. I had to build a paper LBO. So this is, I mean, in my opinion, this is stuff you got to know. And it's difficult, but it's not that difficult. So I've really tried to simplify this compared to other LBO courses that I've seen in the past. So that's that, right? So we build the revenue forecast, gross profit. Again, you could have cost of goods sold up here in another model. I plan to have that, but for right now, the way this was done, it was not as clean as that. Just the way this business operated. Then you've got adjusted EBITDA, right? Let's see. Let's go back here. Let's take a look, right? So you've got adjusted EBITDA. There you go. Then you've got, less total adjusted EBITDA, right? That's kind of, and then it's black because it's doing a formula on here, right? Just a simple kind of going in, and you got your EBITDA margins. You always want to have your margins, y'all, right? Gross profit margin, percent growth for revenue. Like you've always want to have these underneath, right? Just italicized, um, because it shows what's happening in the model. And yeah, so in the case, it's important for the person who's grading the case just understand what you're thinking, right? Less total DNA, EBIT, right? And now, so here's the thing with the LBO, right? We start getting to cash flows. This is the difference is you got to get to a free cash flow figure because then you're going to determine how you're going to pay down debt. But we'll get to that. It'll make more sense. But this is why you're kind of turning it into a hybrid of a cash flow. So cash interest, non-cash interest. Remember, as I said earlier, mezz debt and other forms of debt have PIK components. Paid in kind interest, that's where you don't pay it right then. That helps the returns, but you pay it at the very end. So you have to actually model it out differently. Less tax expense, right? Then you've got your net income effectively, right? Net income is important. This is why it's very important to understand the three financial statements, right? So now, so that's the income statement. Then you've got your cash flow statement, right? Net income plus total DNA, right? Plus depreciation and amortization plus non-cash interest expense. Actually, PIK is an add back because it's non-cash interest if you think about it. Then built a net working capital build below, which we'll talk about. And this looks a little odd. Some of these numbers might be off a little bit. We'll double check. But then you've got CapEx, right? That's your typical main investing activities. Okay. Also, if you sell equipment, that comes back as a proceeds of sale of PP&E. So that's another example of investing activities, but it's not in this case. Then, of course, financing activities, right? Any dividends paid, any debt that you're raising. I mean, that should be pretty obvious, right? Preferred stock, common stock, any of that stuff. That's what comes on cash flows from financing. So you get all those items, okay? By the way, share-based compensation is another one. That's not in here, but that's typically an add back as well in the CFO area. And any gains or losses too go here as well. I know they're not here for the case. I just want you all to know how we think about these three sections of the cash flow statement, right? So then this is where the LBO starts to differ from just traditional accounting, okay? You've got your cash balance. What do you have? Was there an increase in cash? Well, there is, right? So look what happens when you kind of look at this. Well, I guess this is kind of how you get your cash flow statement, but you're about to see it. So here's your ending cash balance, right? Yeah, I mean, I guess actually this is pretty typical, but you're about to see a hybrid of a cash flow statement um, that some folks have it come after here, but I think it's actually even lower on the totem pole. So now let's go through the balance sheet, okay? The three statements. So you want to set up your original balance sheet, okay? All these items, right? Again, I think I went through this earlier, but just so you're aware, map out your balance sheet, okay? You don't need to make 50 line items. Let's make, you can put things in other assets. You can put things in prepaids. You can put multiple ARs under one AR, even due from individuals is technically an AR account. So use your judgment, right? This is why having a strong accounting fundamental is very important to investment banking, because you are looking at the financial statements. You got to build models from scratch, all that. Okay. Um, that's kind of where we're at. Then take a look at this. I'd say you've got all these various line items that are pulling in same sum ifs ordeal. This is your total assets, right? Remember, your total assets have to equal your total liabilities plus equity. Same thing with the liabilities and equity. Created various kind of accounts, right? I lumped in AP and AE here. That might have not been the right play, but whatever. It's not a huge deal. It's not the end of the world. Nobody's gonna, you know, not give you an offer for that, right? So, um, equity, right? Then yeah, so then you've got your equity play. Let's take a look at this. Actually, I'm curious what the equity looks like here. So, that's like your retained earnings, right? And yep. So just take the total shareholders' equity at that point, right? Um, but the thing is with an equity, you're going to have to incorporate it too, right? So this is what can make some of these models complicated, is not just how you're doing it historically, but how you're setting it up, right? So this is also why on the balance sheet component, you always have to have a check, right? And you move it moving forward. Um, this can be sucky, honestly. I could say another word for that, and I'm not going to say it, but this is the hardest part of a model, is to get the balance sheet to balance as you move forward. But and I don't have any tips or tricks, right? Some folks have tips, tricks. Check if this is off, this is off. You're running a financial model. This is going to be very detail oriented. It's going to be very nitty gritty. You just got to make sure you check literally everything piecemeal, and you'll find out where the error is. It could be anything, honestly. Like, things have to flow through all statements. Remember that. Like, if it flows in one area, you got to make sure, if you're putting on the balance sheet, like, just make sure it probably needs to go through the income statement. Just make sure things are flowing accordingly. But you know, you just that's how these work. But this model, the way this is set up, this should work, right? I mean, it's balancing right now. And so when you look at things like retained earnings, right? Look at it. It's, you're adding it in, you're adding it in. I think there's a retained earnings build. Let's see. I guess this is the beautiful part about Macabacus too. Remember, you can easily trace these formulas. So there you go. Yep. So you can see right here, you got your income statement. It's adding in my net income, right? And it would subtract dividends too. If we, a lot of times you hear of PE firms, doing dividend recaps, things like that. But there were no assumptions here. So of course you'd want to subtract those if you had to do it. I don't think you would have to do it in a case, but you never know. Um, so now, right, this is kind of how you set it up. Now let's take a look at this. This is interesting, right? This adjustment. This is kind of the whole purchase price allocation concept. So remember, we used existing cash on the balance sheet, right?